Ladies and gentlemen, good afternoon and welcome. Emkay Global Financial Services takes great pleasure in hosting the Q1 FY23 results conference call for Ugra Capital Limited. We have with us from the management Mr. Sachin Nath, who is Vice Chairman and Managing Director, Mr. Amit Mande, Chief Revenue Officer, Mr. Anuj Pandey, Chief Risk Officer, Mr. Amit Gupta, Chief Financial Officer, Mr. Neerav Shah, Chief Strategy Officer and Head of Investor Relations, Mr. Rishabh Garg, Chief Technology Officer, Mr. Subrata Das, Chief Innovation Officer. So, without any further delay, I would now like to hand over the floor to the management for their opening comments. Thank you, and over to you, sirs.
Good evening, everyone. I'm Sachin Nath. Thank you all for joining our Q1 result presentation.
Yes, Sachin, we can hear you.
Yeah, go to the next slide, please. So, in fact, this we have, we started this in our last quarter as well. Our belief, is that unlike consumer credit business in India, the small business financing is also rapidly embracing the data-driven underwriting. Since the start of demonetization and advent of GST and creation of 3-layer of India data stack is ensuring that in over next 2 to 3 years, the entire SME credit space would move to a data-driven underwriting. The identity layer, the payment layer, and the data layer, combined with the power of multiple alternative sources of data, would move the credit to 3 different forms of credit, which we call embedded credit, flow-based credit, and buy now, pay later. And this is also massively supported by the now, which is fully implemented, the OCEN network. And once the ONDC would come, the merchant financing business would also become very, very prominent. This also we said, we have been saying this over a period of last many quarters, that there is a transformation of NBFC lending space is happening. The NBFC lending space is getting divided between, some very large capitalized owner-driven NBFCs and the larger ecosystem which has to converge to lending as a service. We have seen the last companies, across Europe, UK and US. But India is now seeing the evolution of lending as a service. What basically it means that unlike conventionally, all of you have seen that lending outside the bank through NBFC is a business of leverage versus now it is becoming business of service. On one side of the spectrum, where we specialize, is being able to find, or what we call source, filter, underwrite the customer. On the other side of the spectrum, we have the owners of the liability or the liquidity, which is banks and large financial institutions. The way we design ourselves, that while we are a principal lender, we have a highly capitalized balance sheet and we borrow on our balance sheet. But our eventual goal is being able to service the large ecosystem of small businesses in India, being able to filter them, use our data-driven underwriting and clear them through our score. And finally, the balance sheet belongs to the large banks. And that creates a very large cash, fee generating model for businesses like NBFCs or fintech, whatever you may want to call it. Over the next few slides, we'll explain that how we are evolving from a leverage business to LAS as a business. But over this Q1, we have, we have been able to prove that this is happening. We have been able to cumulatively disburse 6,000 plus crores over a period of last 4 years, of which, roughly around 2 years were lost. We have an asset under management of 3,650 crore, which is a growth of almost 700 plus crore over a period of 1 quarter. And we have an off-book AUM, which is 780 odd crore. So from a 16% of our balance sheet, which was off our books, now we have moved to 21%. We are now servicing 25,000 plus customers. We have a physical footprint of 95 plus location. Beside our, roughly around 1,400 people, we have around 1,000 plus partners who services our customer base. And for our supply chain business, we have very strong base of 75 plus OEMs and anchors in our ecosystem version. And last but not least, I think so Ugra has over a period of last 5-6 quarters have become a company which services the need of an SME or MSME customer right from a small 1 lakh rupees loan to 5 crore rupees of credit in different format of what we call the product through multiple distribution. So we have ability to do a secured business loan, machinery, unsecured business loan, a micro enterprises loan, supply chain financing and merchant financing, which is a digital platform which will be coming soon. I hand it over to Anuj to talk to you about how the data ecosystem in Ugra has evolved and what data would be doing to the MSME financing ecosystem in India. Anuj.
Sure. Thank you, Sachin. So, for next couple of slides, I will just take you all through how the digital ecosystem has evolved and how we seem to be in the right place at the right time with right set of design and execution capabilities to have a meaningful impact on the very large lending opportunity which is present across SME lending in India. And first things first, a very quick review on how we have evolved in last 3-4 years, how we have been able to apply data analytics and technology not only in the very core area of underwriting, which I will explain in detail in later slides, but also in other aspects of our institution. In fact, we have been readily using comprehensively our data-led insights in early warning systems. We have applied the same approach in our operations and collections team, or at the origination level, right from day one. We have been using it to a very large extent. In fact, to open our new branches in micro locations, we have used data science extensively. So overall, not only in underwriting, we have seen and found a lot of advantages in using technology and data platforms across. So we will probably be one of the first large-scale NBFCs to do that. Neerav, you can move on. And at the very heart of what we have done is what we call a growth score. When we had started in January 2019 with our first loan, we were using the first version of our growth score, which was based on a simple hypothesis and design that when you look at the customer via the lens of the sector in which it operates, one is able to understand his cash flow in much better way, and hence one is able to predict the portfolio performance much better. And this got severely tested, and we passed that test successfully during both pandemic 1 and pandemic 2. Our portfolio has remained intact and is in much better shape vis-a-vis competition. And also during that impact, we learned that the banking behavior also is a very key contributor in predicting future portfolio performance for SMEs. So we launched our Growth Score 2.0 version, which made use of not only
every MSME. So we've designed products starting from 50,000 rupees to 5 crores, products that have tenors from 30 days to around 15 years, and all kinds of needs being serviced. What really this growth score does is growth score really credit evaluates customer, and then if he is worth delivering credit to, depending upon what kind of product he wants, is the customer's price depending upon what kind of security he brings on the table. And so we are able to do multiple products like our loan against property, we do our productive asset financing, unsecured loans, supply chain, and our micro enterprise loans. All of these revolve around this one simple concept of growth score and supported by our platform. More importantly, on the distribution side, we are now at about 96 locations.
Amit, we can't hear you. We can't hear you. Amit, sorry, we can't hear you.
Can you hear me now?
Yeah.
So I was talking that our distribution strength continues to improve quarter on quarter. We have about 96. We are now in 96 locations, more than 1,000 grow partners. Our ecosystem of anchors and OEMs who power our supply chain and the productive asset financing, machinery finance business, again has been growing quarter on quarter. And of course, our employee strength at the front end now is more than 700 people that that work on all these platforms. If we were to look at how our distribution is, Nirav, can you go to the next slide? Yeah. How our distribution is, we've realized that there are multiple customer cohorts that we want to reach to, and we have very different distribution models. A branch-led channel looks at the prime branches and the micro branches. They service the intermediary distribution. They take to the customers our loan against property, our affordable LAP, our unsecured loans business. Our ecosystem business distribution model actually harnesses the ecosystems of the anchors for the supply chain, both on the vendor and the distribution side. It harnesses the ecosystem of the OEMs for the machinery finance business. There's a large, like I said, on the Grow Extreme platform, on one side, there are a large number of partnership and alliances, NBFCs and fintechs, where we do very, very differentiated products with them to reach to the last mile. And most importantly, our digital direct to customer digital channel that will now get enhanced by end of August to really step up our customer acquisition engine. And this will be one of its kind direct to customer channel that we will launch in August. We will of course see the launch. It will be a visible launch, and we will be able to divulge a lot of more information possibly in the next quarter. But as we continue to build our distribution, as we continue to build our asset book, one important thing, Nirav, I wanted to talk about the lending as a service platform. So if you could go to the next slide. As we continue to build this, our partnerships with the PSU banks and the NBFCs for co-lending and SFCs continue to increase. In last quarter, we had about 5. We've now increasing this. We've got Punjab and Sindh Bank on board. We've signed with Punjab and Sindh Bank for all products. By next quarter, we will have another 2 banks having signed up. So that takes care not only of just our liability position, but our ability to off-book our AUM. Look at how beautifully the off-booking of AUM continues to grow quarter on quarter. So last quarter we were at about 16. This quarter we are at 21% of our AUM off-book. And this is thanks to all our partnerships with the PSU banks and some large leading NBFCs where we do co-lending and co-origination. Nirav, can you go to the next slide?
I'm on the next slide.
Okay,
slide 15.
Okay, I don't know if the slide is changed, Anuj, for you.
Yes, it is changed.
Okay, so I'll continue. So we kept saying that we wanted to do lending as a service. We wanted to build a large. When we spoke last time after our annual results, we said that we wanted to build a 7,000 crore AUM by end of the year, and this is really where we are saying that we are absolutely on track to deliver. We had a great first quarter. Our AUM stands at about 3,656 crores. Off-book AUM is at 21%. Our net total incomes remains healthy at 10.5. Importantly, our credit cost is very much under control, and so it's at about 1.4%. So overall, I think the real message here is that we started this year to get to a 7,000 crore AUM, 35% off book out of that, and a 2% ROA, and more than 2% ROA. And I think we are completely on track to get to those numbers. First quarter has been a testimonial of that. So with that, thank you, and I open this for discussion.
Ravi, I think we should just take up the questions one by one.
So an anonymous attendee question: what percentage of sourcing is done through the DSA channel?
So at this point of time, 55% of our business comes from the prime branches, and in which there is also machinery finance business. So amongst our book, about 48 to 50% of our book will be generated by the intermediaries. The rest 50% is through direct and through other partnerships.
Do we have any other questions in the chat?
Can people ask question, or they have to only do it through chat?
Okay, we have a question from Mr. Chinmay Bhargava. Nirav, if you could please unmute his line.
Hi, Chinmay, please go ahead.
Hi, good afternoon. Nice to see you all, and congratulations on the numbers this quarter. I have about 3 questions on the business, so let's get started. The first question is on our growth score, and we spent a lot of time explaining this, but I have a few more basic questions with the growth score itself. So we have 25,000 data points, as you've said, right? But the more data points we add to a model, the more complex the relationship becomes between the data, and the more noise and contradictions you'll have between different data points. So what framework do we use to choose which data amongst that huge set to prioritize? And could you tell me if we're using like a Bayesian framework, a stochastic framework? How are we using our probability models? And more basically, if we take a case study, right? Like if we discuss nursing homes, for example, can you tell me how our understanding of this single business has changed from grow 1 to grow 3, where we are now?
new model, what kind of testing we want to do in terms of back testing, and once it goes live, then at what rate we should do proof of concept.
Yeah,
Brilliant.
Just I want to add that the difference between 2 and 3, the 2 predict the default, categorize the customer in 5 bands. 3 would be able to predict the default as it is being done in 2.0, but also would be able to predict the ability of the customer, whether the customer can afford 100,000 worth of loan or a 250,000 worth of loan, which is today is estimated through a policy and product program on the front end. So that's the core difference.
Okay, so your approval rates, false positives, all of that will improve. Your early warning systems with real-time data, all of that will improve. Brilliant.
Yes.
I have one last question from my side, which is, if I look at our sector mix now, this quarter, and I compare it to Q1 FY22, I can see that education and hospitality, which comprised about 15% of our book, is now down to below 5%, for example. I know this was because of restructuring, but my question is, what is our plan for education and hospitality going forward? Are we going to be looking at a different sector? Do you see it returning to, giving us the scale that we chose it in the first place?
So we are already seeing a lot of encouraging signs in both these sectors, both in terms of our own portfolio, which is a good a portfolio which has been restructured, and lot of demand also seems to now getting up, especially in education with children going back to school. So slowly the plan is to keep building this up.
Okay, thank you so much, and all the best for the year. I'll jump back into the queue.
Thank
you. We have the next question from the line of Anadi. Neha, if you can please mute your line.
Yeah, I've done that. Andy, please go ahead. Anandi, just unmute yourself and please go ahead with the question.
No questions. It was my mistake. Thank you.
Right. The next question we have from the line of Samyak Shah.
Hi, Samyak, please go ahead. Yeah.
Hi, thanks for the opportunity. So I just wanted to understand how this OK network that is used by the company, and how is it integrated with the Grow ecosystem that you all have?
Okay, I'll answer that. So OCEN is Open Credit Enablement Network. The broad concept of this network is to have data in a marketplace, which is data storage, which is driven by a protocol, which is standardized across. The first used case of OCEN in India is a platform called GEM Sahay, where we were the first lender. So the way it works is that GEM Government e-Marketplace is a marketplace. Sahay is the OCEN network over and above that, where on one side the sellers are SMEs and the buyers are PSUs. And the data of their transaction is stored in that marketplace in a format which is universal. That data we have integrated with the GEM Sahay platform. In fact, not only us now, we were the first ones, but there are many more financiers which are doing that. It accesses the moment an SME gets an order on GEM, then their previous history of that transaction and the SME's demographic is available for a financier to make use of, form business rules around that data, and do an instant approval for that case. So we are already live in that. More and more OCEN framework-based platforms will keep coming up once more and more people start adopting that. And from as far as we are concerned, our business rule engines and the API network is ready whenever a need arises to further integrate.
Okay, understood. The other question is regarding the expansion model. So would it be more branch-based going forward, or would the focus be more towards digital penetration? Like any numbers on this?
So, in our earlier plan, we did have a large expansion plan this year on the micro piece. Now, the micro branches, we do micro secured, which is a high yield secured product, and is a focus product for us. But today with 75 branches, over the next 2 quarters, we want to make it highly profitable and then focus on further expansion of micro branches. Any expansion further from here will only be on micro branches. On the prime branches where we do the intermediated business, there we don't see any large expansion plans. That's number one. Number two, the expansion will be in products of machinery finance, supply chain, and direct to customer, which essentially means that to a question that somebody earlier asked, what is our direct distribution and what is our intermediated distribution? Our focus is to keep improving our direct distribution going forward with micro branches and with the businesses where there is direct to ecosystem and there are no intermediaries. So did I answer your question in terms of what are the plans on distribution and expansion?
So it will be selective in terms of which areas require intermediation, like a personal contact with the customer. So, like as you said, in the micro area.
The answer is that we will continue to expand our micro branches where there is a direct to customer digitally assisted footprint and a direct to customer digital acquisition.
All right. And my last question. So just a lot of people would still not know how to go about a loan approval or loan application process. So is there anything you are doing for improving, awareness about how to go about this online loan application procedure?
So 2 things. One, the moment I said that we are going micro branches, direct distribution, we have feet on street. So it is a customer assisted model. And so we'll assist the customers to run through their customer journeys. On the direct to customers, we will start with very simple, small tickets, small tenor products where the data requirement is very low, and eventually take this up to a more complex product where we need their involvement, or where we need data on their GSTs, where we need data on their securities, their properties, or whether it's machinery. So initially, direct to consumer will always be a little simple journey, simple data requirements, and over a period of time, will graduate with the customers to higher end products.
Okay. And one last question. Could you possibly give me a split between off-book and on-book disbursements for last 2 or 3 years?
Given, if you look at a few of our slides, you can see that as of March 22, 16% of our book was off-book. As of Q1, and it is 21%. We are targeting, as of FY23 to be 35%.
I was talking about the disbursements. That I think is the AUM, correct?
Right. So the disbursements month on month will be in the range of between 35 to 40% of book.
utilized to buy shares from the market, which would be held in this trust for the employees pool, and employees can vest these shares. I think so in year 25, if I'm not correct, if I'm not wrong. So they, as and when there is a market opportunity, this employee welfare trust independently would buy from the market and hold it, and then it was like an ESOP scheme. These shares would be held in the trust for the benefit of employees.
Okay, so this the money would come from the loan given to the employee. Exactly.
Loan given to a trust.
SEBI
regulation on ESOP allows this, that either there's an ESOP which can be directly given by the company, or you can implement an ESOP through a trust. So there is a loan which would be given to the trust, and that loan money can be utilized to buy share from the secondary market.
Oh, thank you so much.
When the shares would vest in 2025, employees would pay the cost of acquisition to the trust, and trust would then return that money to the company. Or employees can ask the trust to sell the shares and pay the difference to the employees, and the principal amount would come back to the company.
That's very good. Thank you so much. That was all from my side.
Thank you. We have the next question from the line of Chet.
Oh, hello. Hi. Congratulations on the good set of numbers, especially in AUM and fee income. I had 4 questions which have accumulated as the conversations went. I'll just start with the most recent conversation we had. So on ESOPs, will this transaction, count towards the 8% cap in the Articles of Association?
So we have, sir, 5.88%, which is the ESOP. And I think so you're right. This will be roughly, around 8% in total. I think so we are going for a shareholder approval. So absolute quantum is 30 crores. And if this quantum, because we don't know what real percentage of shareholding we would be able to acquire, because it's a function of price. And, in a particular year, you cannot do more than 2%. Yeah. But if it crosses the, cap percentage of 8%, so when we are going for shareholder approval, whatever is the calculation, we will request for shareholders to approve for that change.
That's great. Okay. Then the second question was on the competitive landscape in co-lending. So if in co-lending, if we say that we are the leading partner for banks, especially PSU banks who have issues with, front book growth and front book quality, who's our next competitor? And, how far ahead are we, in terms of using the data tripod, etc.?
So it's very difficult to, talk about who our next competitor are. We can only talk about ourselves. So in terms of this co-lending as a business model, let me give you some perspective. So there are, look at from a large public sector bank's perspective. Think of an SBI or a Bank of Baroda or a Union Bank or a Canara Bank. Most of them would like to partner with an NBFC of substance. NBFC of substance means that they would look at some significant amount of capital. They would look at a profitable track record. They would look at a healthy portfolio quality, and some vintage, and then they would like to partner. So this is what banks want. Now, if you look at in terms of the market participant, you have 3 types of, and last but not least, co-lending is only for priority sector. So the asset class which can go in co-lending is either MSME, agri, or underserved market, and nothing beyond that. So fortunately, then you look at the market participants. So there are 3 types of participants. You have AAA to AA diversified large NBFCs. I think so for them, because not necessarily that most of them are in priority sector. So there are a lot of assets these large NBFCs do, which is beyond priority sector, and also for them it is much easier to take a leverage on the balance sheet and continue doing the business as they want, because their balance sheet would have a combination of wholesale, corporate credit, wheels business, SME, gold loan, so on and so forth. And that's why most of those top 10 large NBFCs are today not entering into co-lending, and most of their asset classes are also not fitting for the bank. Mm-hmm. Then you have roughly around 50 plus NBFC, which are while in SME or agri segment, but are neither well capitalized nor the portfolio track record wherein they can get accepted by the bank. Let me classify them anything between BBB- to a BBB+ companies. and that's why that segment of the market is also getting exposed. We, as Ugra, with 1,000 crore of capital, with A rating and 5 year of vintage, with a very massive portfolio quality and focus on digitization, are becoming a preferred player for multiple banks to do co-lending with us. I'm not saying that we would only be the one who would be doing it. Over a period of time, there will be a convergence which would happen. The large NBFC would also start doing co-lending, and smaller NBFC would become little larger and do co-lending. But we think so that we have a window of becoming market leader in this in next 3 years by the time this catch up happens.
Okay. And in terms of our micro branches, are they like a strong contributor in this co-lending portfolio? And how do we avoid cannibalizing with our partner PSU banks?
I don't understand the question on cannibalization.
So basically, our micro branches, they don't compete with the likes of Bank of Baroda, Punjab and Sindh Bank, right? We've made sure that they don't compete with them.
Sir, our segment of the market don't compete with the banks.
Okay,
I think
great.
Across every segment of the market, I think it is proven by time that the segment of the market which a fintech or an NBFC service, while banks have much bigger, larger, massive presence, we cater to two different needs, right?
Yeah.
So, even if in a same location a bank's branch would be there, their method of underwriting, onboarding a customer and assessing a customer is completely different. If you look at a longer term time horizon, 10 to 15 years, banks would learn to be bigger contributor in terms of the overall portfolio yield and profitability. In terms of the AUM growth, they may not be a very large contributor as of now, but they are increasing. All our banking partners are accepting our micro enterprises credit policy as a product for co-lending. And gradually, as the funnel would increase, that would also start going into the co-origination lending. Amit, you want to add something to that?
No, absolutely, Sachin. To answer the question, the micro secured product that we have is a great high yield product. It's behaving extremely well. And so at this point of time, it also makes sense to keep some high yield secured business on our books. And so it will continue to be on books for a while. And at the same point of time, like Mr. Nath said, we have already started doing micro secured co-lending in a couple of banks, and it will continue to slowly move into the co-lending story.
And a follow-up on that is are we applying stringent collateral checks on this micro secured business?
Absolutely. So there's a clear policy on what we accept as a collateral, and these are very much in lines with what are acceptable by the banks. And so that is essential reason check why even this product is today acceptable in a large PSU bank because of these.
Great. Yes, I got my answer. If SBI and Bank of Baroda are comfortable taking it, yes. So it needs to be one of the list of 10 items. Great. Last question was on the QIP or the our leverage ratio basically. So right now we are at a debt to equity of 2.3. Obviously with co-lending it's not going to rise fast, but as and when we reach 3 to 4, we would need to raise funds to expand. Considering that the stock price, is a function of people,
and that is, that is muting the interest in the lending as a segment of the market. Now we are completely out of that. We have no correlation because pre-pandemic, post-pandemic, we have demonstrated portfolio quality. But once you are in a mix, you are in a mix and you can't go beyond that. But our view is that as we continue to improve and show our growth, there are, intelligent set of investors who would come dedicated for us, and that should improve our both price and also liquidity. Having said that, our source of capital is not necessarily only public market. Our source of capital is multiple. In a listed company, we raised roughly around 950 crore of capital, not going to the public market, but from 4 large private equity investors. So source of capital today is available from private equity, DFIs, big family offices, and multiple others who will compare or who are comparing us to the private market transactions. Yeah. There are multiple NBFCs or fintech who are raising equity capital anything from 3 times price to book value to 7 or 8 times price to book value. And, while you get benchmarked to your listed price, but I think so that's the fair value where we should be, and hopefully some of the private investors would look at it from that eye and angle.
Okay, sounds good. So I think it's fair to say that my calculations that 6 to 9 months can probably be considered that they were too short. The assumption was too short. So we can still sustain quite a few more months or few more quarters.
We can sustain a full year. We can sustain even beyond if we want to.
Sounds good. That's all from my side. Thank you.
Thank you.
Thank you. We have the next question from Mr. Atul Prakash.
Yeah, actually, just wanted to understand. So we have mentioned that we're at 7,500 crore is our plan by FY23 AUM.
7,000 crore.
We book from FY20, the AUM was approximately 800 to 900 between. So we are growing our book to 9x in the matter of 3 years. And then there is a growth scorecard 1, there is a growth card 2, and growth card 3.0 is coming up. So how we are very much confident, this is also backed by the GNPA numbers. If we see, I think 2.13% I think was the GNPA this time. So if we backtest it at FY20, your GNPA number would be very high. So how we are checking these things?
So I would say 3 things. I think so you are only looking the headline number, but you are not looking the incremental OPEX which is being incurred to build the base. So we raised our capital in July 2018. ILFS happened in September 2018. We started our business in April 19. Even between the July 2018 to April 19, a base infrastructure for the company was created. But given the liability market was extremely soft post ILFS, we decided only to deploy our capital. So out of 958 crore of capital, we deployed 850 odd crore without leveraging our balance sheet. And immediately after that, the pandemic first round hit very hard, and we shut down our business in first 6 months. But we were confident that we have to increase our infrastructure. So as of FY20, we were a company of 170 people. As of FY22, we were a company of 1111 people. As of FY20, we were a company of 8 physical locations. As of FY22, we are a company of 91 physical locations. As of FY20, our technology team infrastructure was consisted of 5 people. As of FY22, it was 90 people. As of 20 to 22, our data analytics team were, roughly around grown 5x. So the growth is coming because this company has taken very early big OPEX to build physical and digital infrastructure. And basis that, the growth is now coming. So it's a base effect. Number 2, in terms of the portfolio quality, I think so you can't backtest it basis lower AUM because our low first year AUM obviously suffered from pandemic, but we have demonstrated that during the pandemic, we could control the portfolio quality much better than our peers said. And every business then has to look at, gross NPA on the basis of an expanding portfolio. And, by cohort, portfolio quality and what is the early indicator. So we are showing you an early indicator of how our portfolio quality basis data analytics is building up and what we think would be the portfolio quality at future. Anuj, you want to add something, please?
So I just want to add for a business model like ours, where now 21% of the book is actually off in form of co-lending or co-origination, and eventually at the end of this year around 35%, and in 2025 50%. A good perspective one can get if one looks at the GNPA by total AUM. So by this in this quarter, actually our GNPA is 1.7%. If we add a net NPA at 1.2%, if you look at a total AUM, which is much more reflective of how the portfolio is doing. And in addition to what Sachin, you said, in a growing portfolio, especially the first year, the denominator being lower, and then facing two pandemics, post that, whatever has come out, we are quite confident that directionally we are stacking up well.
Okay, just one more thing wanted to understand on your growth scorecard. So basically, there was a presentation where you were mentioning there was A band, B band, C band, and then there was disbursed loan and there was undisbursed loan. So if a loan is getting A band in your scorecard, why you are not disbursing the same? And basically, how this scorecard is coming up there?
So the scorecard is primarily to predict probability of default, which is based on the financials and repayment behavior of the customer. But many times a customer with good financial track record may not have a good collateral. And we have to say no in terms of LTV. He has come for a 1 crore loan against property, but his property value is 80 lakhs. So many times we have to decline that case. And there could be other reference check reasons as well. Ideally, yes, we should not, but the practical way it works is that there can be reasons over and above that. Directionally, what we want to establish is that growth score stacking works, and eventually once enough data is there, then we are able to increase our throughput much more in desirable segments, basically growth score A and B.
Okay. One more thing, out of this restructuring portfolio which you have gone through, so can we just have a figure what is outstanding as on date, as on June end, and out of which how much is in the 0+ and 30+, 90+?
So our total restructured portfolio at the end of June is 120 crores, which is approximately 3.3% of the AUM. In that, and out of this, 20% has become NPA. Rest, 67% is current, and 4% is in 30 to 90 bucket.
You can also give color of the restructured portfolio by segment of the market. So what has become
we can do that.
Yeah,
we can do that. So overall, if you look at the total restructured portfolio by product, then approximately 60% of that portfolio is undersecured, about 25% under unsecured, and rest in supply chain. And by sector, about 85% of the portfolio is under education, hospitality, or light engineering. What we are seeing in terms of repayment behavior, we are seeing that education and light engineering is pretty back to normal at pre-pandemic levels. In hospitality, though overall segment is now looking up, but the stressed customers continue to be stressed. And we had done an internal analysis in last quarter where we had predicted of how much more NPA can come in especially from the unsecured hospitality sector from our current restructured portfolio, and we have planned for approximately 7-8 crores more NPA coming from there.
And our current provision is more than sufficient to cover it.
Yes.
Okay, just one more thing I wanted to understand. So we are going with such a high growth plan, and we are on the track also on it. So there will be a capital adequacy ratio that you need to be maintaining. So what are our strategies where we want to fix it on the capital adequacy ratio, where we will be maintaining it?
So I think so this has been answered multiple times. It is showcased in our presentation as well. I've said this in our previous answer, and I will try to summarize that. This company regulatory, we have to maintain a capital adequacy of 15%, which means a leverage of 6 times. But we would like to ideally maintain a leverage of not more than 3.8 times or maximum 3.5 times. And by virtue of that, with 35% of our business in off-balance sheet, we would be looking at raising this capital. Now, raising this capital, the timing of it and when and source, we will, consider at an appropriate time. But the company had multiple triggers to continue maintaining its growth without raising the capital as well if it want to. First, we can, with our targeted leverage of 3.5, we can go further. Second, our targeted off-balance sheet asset of 35% can be increased to, say, 45%, and leverage would remain the same. So I think so we have this completely in our control, and this does not worry us too much.
Okay. One last query. The market or the news is there that there will be some inflation will be striking, and MSME sector especially will have some struggle during this period. So, and we are corely into the MSME. So, where we see our business going on that piece?
So, sir, I think so. SME and MSME is an very generalized term which is being used. I think so. MSME and MSME should be looked by the segment of the market in which one operates. And now in the revised definition, even a 200 crore company is also a manufacturing company is also an SME. We service customer below 5 crore of turnover. Large focus of this company is to service the retail trade within our defined segment. And most of our sector are domestic consumption driven economy. Our view is that domestic consumption driven economy, the interest rate rise and inflation would not mute the demand. One of the problem of our controlling inflation in our country, that you have to increase the supply side. Constraining demand doesn't help. So within our customer set, what we have seen till date, neither the credit demand nor the cash flow is getting stretched because we service very small businesses.
Okay. Thank you so much, and all the best for the upcoming results as well. And congratulations on the good numbers.
Thank you, sir.
Thank you. We can take up a few questions in the Q&A session. We have a couple of questions on the line of Mr. Vijay Chauhan. They are as follows. What will be co-spreading income as percent of total top line? Example 3.2% has been taken in the example given on the last slide of the PPT. And the second question is 18% target ROE by FY25. Will this revise further if we prioritize co-lending over plain vanilla lending?
Nirav, the first one can you take? Second one I'll explain.
Yeah, absolutely. So right now, I think basically the 10.5% that we are talking about includes the co-lending or the co-origination income that we say. The spread actually will be about 5.6%, and the rest will be the co-lending income in this particular quarter.
On the next question on the ROE target 18%, obviously, on a 20,000 crore, our current, it is very hard for the listed companies to give projection for the year and for next 3 years. Now, when you do that, you do most achievable targets and don't make blue sky assumptions. While the ecosystem of co-lending is improving with every passing day, when we made this prediction in 2021, there was a general skepticism about co-lending or lending as a service model in India. However, we are proving our hypothesis right by going from 16 to 21%, and we are taking it to 50% by FY25. We know and understand that if we increase it by another 10 percentage point, our ROE would even kick in further. But we believe that pure marketplace model does not go well with when it comes to the lending as a business. All our banks and partners who are on the liability side want to see us as a principal lending partner. So having a skin in the game, having its own balance sheet helps, and that's why we have made an estimate of half and half.
Thank you. The next question is from the line of Mr. Manan Modi. With the transformation of Ugra to lending as a service model, do you see the partnerships and alliances piece going down?
Answer is no. Actually, our aspiration is that we create a bridge. So on one side, and partnership and alliance is one of our channels. It's a very good question. On one side, we have a large ecosystem of small fintech, small NBFCs who otherwise can't get access to a large bank. So today, on one side, we are doing co-lending with them. On the other side, our originated asset, we are doing co-lending with banks. Our constant endeavor is through our experience, our Grow Extreme platform, and our ability, we will like to bring some of our large banks to become a direct co-lender to some of our partners, wherein we work as a bridge of providing technology, some form of credit enhancement and service that. So actually, once one of the such banks become a partner for our larger ecosystem, we think that over a period of time, our P&A partners would benefit from the co-lenders which we are bringing on our platform.
Thank you. The next question is from the line of Chet. Instead of declining customers who have less collateral, can we opt for leading best practice to offer them smaller loans or different terms?
So I think so. Amit and Anuj, I can answer. So look, I think so. We don't differentiate the customer when we are assessing them. So at that point of time, our growth score doesn't differentiate whether the customer is bringing a property as a collateral or machine as a collateral or is an unsecured loan. It says yes and no and categorize the customer in 5 different bands. So to that extent, theoretically, we can offer the same customer an unsecured loan. But the issue is about affordability. The customer who want to borrow against a collateral want a much longer tenure loan because that fits in their cash flow and want a lower yield. So a customer which is coming for a secured loan would not be satisfied with a very small unsecured loan. And also from a risk perspective, we offer up to 3 crores in secured, but we offer only up to 25 lakh in unsecured loan. Amit, you want to add something I think about this?
No, absolutely. You answered the question, Sachin.
Okay.
Thank you. The next question is, how many micro branches do we plan to open this year? How is the performance of the branches launched last year in terms of productivity and payback period?
Okay, I'll take this question. So we opened about 70 odd branches in Q3 and Q4. As per our projections, we have a 12-month break-even plan for each of these branches. By end of this quarter, the first set of branches have broken even. We will see all these branches at a break-even and delivering high profitability by December. Once proven, so while the first few branches have proven that they can be profitable in the first 12 months of launching, and so once proven, I think we will look at the next stage of expansion. We depending upon how these branches behave and how early they break even, we will look at anywhere between 25 to 50 branches in this by this year end, possibly in quarter 4.
And overall, I think so for 2025 plan, in our identified 5 states, Telangana, Tamil Nadu, Karnataka, Rajasthan and Gujarat, we have done massive data analytics of roughly around 3,000 plus PIN code. And this is a cluster approach, and we believe that there are 280 clusters in these 5 states where we would eventually like to be present purely from opportunity and credit quality perspective.
Thank you. The next question is, co-lending is a space where banks have good cash and the co-lender has good presence in areas where the bank is not present. But with Ugra, we have very few touch points. How can we benefit the most among competitors?
So I think so it is not a question of, it is not necessarily only physical touch point which matters. Over a period of time, our touch point would also increase. But our origination and sourcing engine is multi-force. So while our physical branch footprint, the top 25 location and what we call prime customer can, 40 to 50% of India's, MSME credit outstanding is within these 25 locations. So you can get as much volume as you want within that 25 location. Our current 70 location, actually they can, they are the first prominent point of credit origination purely from a cluster, corresponding cluster perspective, and that would continue to grow. Third, we have a machinery financing business, which actually not necessarily require every point physical presence, because our source of origination is our OEM partners. Today, there are roughly around 180 OEMs in India. We are live with a large number of them, and it is increasing. And as that increases, your customer origination keep increasing. Our supply chain financing business again is, as you continue to increase the number of anchors, the distribution channel, the distributor, the retailer, they can be anywhere, but the entire collection engine for that is driven digitally, and that is also will go in co-lending. Our P&A channel services almost the entire universe of India, and their collection and infrastructure is being serviced by our partner. And whenever merchant financing platform would go live, you can be anywhere and we would be able to finance it. That would also go in co-lending. So I don't think so that physical presence is any constraint. Our digital infrastructure, our partners' infrastructure is what drive and propel our co-lending partnership and as well as our own balance sheet.
Thank you. The next question is from the line of Mr. Chinmay Bhargava. How soon do we expect to finalize a co-lending partnership with a private bank?
Chinmay, thank you so much. Last week we have signed our first co-lending partnership with a private bank.
Thank you. Next question is from the line of Mr. Manan Modi. Regarding geographical expansion, are there any key states that might contribute to growth? Especially West Bengal has seen some issues lately. Have you seen any stress in that state as well?
This is a very interesting question. I think in our last board meeting, some of our independent directors raised this question and we presented the data to this board. Anuj, you want to take this?
Yeah. So overall, where we are present currently, and as Sachin was alluding, when we had selected sectors and when we had launched initially, we have mapped the sector concentration with the geographies where they were prominent. And we are from our coverage perspective, we covered about 75% of total available target segment through our distribution network. Today, we are seeing healthy growth across all geographies. In certain sectors, owing to pandemic, we had deliberately slowed down, but for other sectors and across all geographies, we are seeing a very, very healthy growth. In Kolkata too, although in Kolkata we are present only in Kolkata city, and in our kind of target segment, where with turnovers of businesses up to 5 crores, we are not seeing any stress at all.
Thank you. Ladies and gentlemen, do we have any other questions?
I think that's it.
Thank you. As there are no further questions from the participants, I would like to hand the conference over to Mr. Sachin Nath for any closing comments.
Yeah. Thank you so much. Our endeavor have been over the last 2 quarters is to explain our business model, the evolving landscape of how data and digitization would transform the SME financing in India. While we know that this from an outside, this seems to be a crowded space. People look at multiple number of NBFCs, and I keep hearing this question: what is the core differentiation? We are trying to explain that differentiation. And I think so we are gradually making the breakout of how multiple platform in the West has benefited and how our customer can benefit from that. From day one, while we have never done a formal IPO, but we started as a listed company, raised all our capital in that, in hope that the broader public market would appreciate the business model. Because one of the things which is actually which is very unique, that when we look at our peer set who are not listed, most of the investors who are putting in capital is at a very high threshold, and eventually they come to the public market, and most of the public market investors are buying them very, very expensive. Versus we think that we showcase an opportunity to public market investor to benefit like a private equity investor of benefiting from our growth, quality of business, and huge infrastructure, both digital, technological, and also people infrastructure which we have built. Please feel free to ask any question if you have. Nirav is here to support, and we will see you next quarter very soon. Thank you.
Thank you, sir, and the entire team for patiently answering all the queries. I would also like to thank the participants for making this an interactive session. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.